Go ahead.
Okay, brilliant. Welcome everyone to the fifth BitSilk Monday meeting. We had a stacked out agenda last time with our Sandstorm Gold pitch, so we actually missed a macro briefing. So that's exactly what we're going to cover today. On a side note, I've got a new headset now. I think it's pretty cool. And hopefully you can all hear me a lot better now. So things are heating up in markets a bit, so let's get down to business. What we're going to do today is revisit those 5 indicators we looked at in the first macro briefing. And that's for US 10s, the jobs figures, indices, oil, and finally world trade. And it's been 5 weeks since then, so let's take a look at what's happened. Just a quick disclaimer, this video is for training and educational purposes only. And I just need to cover this because we're going to be posting this onto the YouTube channel. Right, so boom, let's look at yield. I talked about this a bit in the macro for gold, but look at yields. They've gone to a very, very low level now. And you've all heard that the bond market is always right. And since the first macro briefing, yield and stocks moved in tandem. But mid last month, you can see on the chart on the right here, bonds and stocks actually diverged. And the stocks drifted higher whilst yields sniffed out the all-time lows. So what's the bond market telling us? Well, it's screaming in our ear that there's going to be some big deflation coming. And why deflation? Well, this is because of factors such as the slowdown in the business cycle, followed by trade wars, followed by the oil crisis, and then followed by COVID. But essentially what we have is when there's an excess slack in the economy, that's deflationary. But what about the QE? Isn't that inflationary? And yes, that's true. It's likely QE will be inflationary this time in terms of CPI and not just asset prices. Because what's different about this round of QE is it's combined with the fiscal. So in all the previous QEs, the fiscal balanced out the QE. So over the last 10 years, when we've undertaken this extraordinary monetary policy, one of the reasons it wasn't inflationary is because we have a complete offset of the fiscal. So even though the price of money was low, the velocity of that money was essentially shrinking because of the fiscal multiplier of that fiscal austerity. And then when the Trump presidency started, it flipped. So the US had a big fiscal expansion, which was then offset by tight monetary policy, again, working in opposite directions. Now the monetary and fiscal are both working in the same direction, which is long-term inflationary. However, in the short term, we have this excess slack, which is very likely deflationary. And that's priced in bonds over here. Next, the bond market is telling us the big boys, the smart money, they're worried about near-term economic prospects. So forget risk-free return. This is return-free risk. In other words, investors are willing to accept increasingly low yields just for the preservation of their capital. Next is jobs. On the whole, with a short-term view, very good, beating the consensus estimates. U3, which is the official unemployment rate, came in strong at 11.1%, beating the consensus estimate, which was 12.4%. By the way, if you want to get all this data, just head over to Forex Factory, and they have a nice tabulated form which links to the BLS source document. And this table I got on the right here, that's actually from the BLS employment situation document. And that even includes all the jobs numbers for individual sectors too. So that could be useful for your pod research. Moving on, the U6 number, which is at the bottom there, that dropped from 21.2% to 18%. And it's very important to also look at the rate of change basis of these figures, because the changes at the margin could signal bigger trends. Looking at this from a rate of change perspective, it's increasing from a 10% move from April to May to a 16.5% move from May to June on the U3. So that's quite positive. But there is a caveat. So this data was collected prior to a lot of these lockdown rollbacks. And while some jobs are being recollected, some of those losses we had in that initial really big dip are becoming permanent, with permanent job losses rising to 2.9 million. And this fits very nicely into our W framework, where economically we won't get back to pre-COVID levels. Okay, so indices. Well, the NASDAQ has exploded since last time. Anything tech has performed very well. It currently trades at an astronomical 10,341.9 points, about 6.8% above the February high. On the other hand, the S&P 500 has grinded higher to 3,174, and it's still 8.15% away from its Feb high. When we look at these charts, the first question we might have is, why has the NASDAQ 100 outperformed the S&P 500? And that's because we know tech has been a beneficiary of COVID-19 generally. The tech-orientated firms they've better managed the lockdown, and some have even capitalized on the lockdown. However, this astronomical rise in the NASDAQ 100 to me is a bit of a bubble. Tesla's at 1,000, that's certainly not justified. I'm sure if Elon Musk, I'm sure Elon Musk would happy to eat that if the S&C wasn't on his tail. So in other words, this explosive price action of the NASDAQ 100 is from mania, it's from speculation, much like the internet bubble of 2000. And this contrasts to the S&P 500, where we haven't got that level of mania in the S&P 500 yet. The Fed liquidity and don't fight the Fed flows have been driving the S&P, but this speculation has not reached the, let's bet the mortgage and kids on Tesla options with 100 times leverage level yet. So if you want a bubble to pop hard, you need that kind of mania where the fundamentals get thrown out the window. And we saw that with the 2000s tech bubble, with the 2000s subprime CDOs, and also 2017 Bitcoin. Rather, what's happened in the S&P 500 is the volatility has been muted, and then you have your flows that have started coming in again, because from a market perspective, the Fed has essentially backstopped the market with this cushion of liquidity. And you've been hearing this don't fight the Fed rhetoric a lot recently. And it's been a complete echo chamber of don't fight the Fed. And I think because of that, people are getting a bit complacent recently. So the market has seen case counts increasing, but it's discounted that information saying Fed's got your back. But as more states will have to go into lockdown, into partial lockdowns, that could be a wake-up call. Could the market discount lockdown re-rolls? Probably not. So Texas has already re-rolled into partial lockdown, and the R value for the USA as a whole is 1.1. And these kinds of growth rates of the virus, they're unsustainable. And the market can ignore these numbers, but the governors of these states can't. So they will have to eventually do partial lockdowns, such as what happened in Texas. And that's when the market might drop again. So it was Corona and lockdown which made the market fall off its arse the first time. So it would be quite fitting for that to be the trigger the second time. But you have to note that because we do have this liquidity cushion, the Fed is effectively backstopped the market at some point above the lows. So it probably won't be the be-all and end-all downswing, but some vol to the downside is, I'd say, highly likely soon. So next we have oil and world trade. And oil is picking up in price as demand recovers. We have the EU safe zone, which has now been established with those 14 countries. And on top of this, the UK's air bridges were released just a few days ago. So flights are going to pick up steadily now. In terms of world trade, we have Director General Roberto Azevedo. And he recently gave an update saying the recent data is on track to meet the optimistic projection of a 13% contraction. And I took that quote because I thought it was quite interesting that the most optimistic scenario is a 13% contraction. So coronavirus has accelerated this trend away from globalization. And we saw that with Trump's policies, with Brexit, and more recently countries being worried that they just realized they're importing 90% of their medical supplies. So what does this mean? Well, this is all long-term inflationary, because if globalization is deflationary because goods get cheaper, on the flip side, you have deglobalization, and that does the opposite. So this fits very nicely with our monetary and fiscal duo that I talked about earlier. And so I think in the shorter term, we're deflationary, but over the longer term, we've got a lot of inflationary catalysts there. It's important to note that oil and world trade are being led by COVID-19 right now. So the COVID cases and how we handle that is actually one of the most important indicators we have right now. And with that, thanks for listening.